Looking to get funded? Smart Prop Firm is your go-to platform for exclusive deals on the top futures prop firms. Get the max discounts possible, earn smart points to redeem free prop accounts and get a free payout bonus, and enjoy payout protection in the event that your firm doesn't pay you out. Use code SMART at checkout, click the link in the description to maximize your trading benefits. Most traders don't truly understand fair value gaps. In this video, I'm going to break down exactly what a fair value gap is, why they work, and I'm going to review to you guys the 3 different types that you absolutely need to know about. If you've ever been frustrated by fair value gaps that fail or fair value gaps that never get retraced into, I'm going to show you why and how to identify them. So let's first set out the foundation. So what is a fair value gap? A fair value gap, or FVG, is a price imbalance that appears in price action. It forms when you get a 3-candle sequence where the middle candle has an area where the wicks of the candle before and after it do not overlap. This leaves behind a visible gap in price action, a sign that one side of the market, either buyers or sellers, pushed price quickly and aggressively, leaving behind an imbalance. Now, why is this imbalance important? It's because the market is all about efficiency, and these gaps create an inefficiency in the market. A bullish fair value gap is called a BISI, Buyside imbalance, Sellside inefficiency. There is an imbalance on the buy side because price is moving higher, leaving price inefficient in sell side. A bearish fair value gap is called a SIBI, Sellside imbalance, buy side inefficiency. There is an imbalance on the sell side because price is moving lower, leaving price inefficient in buy side. Again, the market is all about efficiency. I want you to think of fair value gaps, imbalances, inefficiencies. They're all the same thing, by the way. Think of it like a paint roller. Imagine you dip the roller in paint and you do one continuous stroke up a wall. Eventually, you're going to run out of paint and have a spotty, almost blank area. So think of price as our paint roller. And think about the retracement into these inefficiencies as the act of grabbing that paint roller, dipping it in a bucket of paint to then continue painting up that same wall. When we displace and expand, we create these inefficiencies in price, the fair value gaps. But in order to continue higher, price needs to come back and get more paint in these inefficiencies before we could continue to paint higher. We call this offering fair value because a fair value gap is a gap where there is no fair value. It was only one-sided price action. So the market looks to rebalance and offer fair value to other market participants. And it really is as simple as that. Price creates inefficiencies. Price will look to retrace to inefficiencies to create efficient price action, and then price can continue in the direction that it was on. I'm serious when I say this. If you could just avoid 99% of all the noise you hear out there about how the market moves and just view it through this simple lens of offering fair value and seeking liquidity, your whole perspective on trading will change. You will realize how truly simple it is. Now, because of everything we've gone over so far, we can begin to see how fair value gaps are ideal areas to look for trade ideas from. And since they appear on every market and every time frame, they are applicable to all styles of trading. Scalping, intraday trading, swing trading, position trading, long-term investing, you name it. Fair value gaps are applicable on all styles. But remember, not all fair value gaps are equal. So let's dig a bit deeper. Let's take a look at the anatomy of a fair value gap. The way the 3rd candle of a fair value gap forms can tell us a lot. You see, the 1st candle of a fair value gap could form however it wants. It could be an expansion, it could be a consolidation, it could be a very whatever, like it could literally be whatever. The 2nd candle of a fair value gap will always be an expansion candle. Now, the 3rd candle of a fair value gap could be either another expansion candle, it could be a consolidation candle, or it could be a rejection candle. Now, this 3rd candle, the way it forms, determines the probabilities a fair value gap gets retraced into or even holds in the first place. Now, for a bullish high probability fair value gap, and this also applies to a bearish high probability fair value gap, but we're just using a bullish example here, the 3rd candle is a consolidation candle, ideally failing to close above that candle 2, just the middle candle's high. You see, when the 3rd candle consolidates, it's not showing major bullish intention nor major bearish intention. This sets up an easy move for price to come back into the fair value gap, rebalance, and then continue higher. Now, how does this differ from lower probability fair value gaps? And by lower probability fair value gaps, in this context, I'm just meaning the probabilities that that fair value gap actually gets retraced into. What you see in front of you is a breakaway gap. This is when the 3rd candle is an expansion candle and closes above the 2nd candle's high. This creates an expansion candle showing strong upside momentum. When this happens, price is showing major bullish intention to want to push higher immediately. Price often seeks out its draw on liquidity before it even thinks about retracing back into that fair value gap. Because of this, breakaway gaps typically remain open. All this expansion right here on a lower time frame is bullish order flow, meaning fair value gaps are already pointing higher likely on the time frame below this current one. Again, just confirming the intention to want to push higher right now. We're likely going to respect the fair value gaps seen in this expansion candle right here to then use to move higher. Now, the following is the lowest probability fair value gap. These are called rejection gaps, and they form when the third candle closes as a major rejection in the opposing direction of the middle candle. This is typically seen with a large wick or expansion candle in the opposite direction. Oftentimes, you will see a very small fair value gap created here. When this happens, it shows a strong presence of opposing intention in the market, thus signaling more 50-50 conditions rather than clear one-sidedness, thus making this a lot lower in probabilities. So why focus on high probability fair value gaps? Well, by filtering for high probability fair value gaps, you avoid the frustration of waiting for gaps that either never get filled or fail as soon as you enter. It's about focusing on the setups with the clearest intention and the highest chance of playing out properly. Now, be aware of these common pitfalls because those high probability gaps that we talked about can fail if you are not careful. So some of the common traps include ignoring the higher time frame. Even the best fair value gaps fail if you're trading against the trend. Always be sure to conduct a proper top-down analysis. You don't want to be logging a bullish 15-minute fair value gap if we have just stung into a bearish daily fair value gap. And you can completely avoid this by doing a proper top-down analysis, which is exactly what my last video was about. So I will link that in the top right. I highly recommend you watch that. That is probably one of the most important videos on this channel. Another common pitfall is trading inside of trapped order flow. When setups form inside trapped order flow, price can chop around, cause delays, or just completely fail. This is where you're going to find those nasty consolidations and those seek and destroy conditions. It is when price is stuck in between a higher time frame, premium, and discount array. There's a reason to go lower and a reason to go higher. So for example, we have a daily bullish fair value gap that we have just stung into right here, but we are coming into a bearish 4-hour fair value gap right here. We're stuck between a higher time frame discount and a higher time frame premium array. Discount array, again, just as a reminder, is any support level, which is a fair value gap. A premium array is any resistance level, which is this 4-hour bearish fair value gap. Another thing to always keep in mind as well is the economic news calendar. You always want to be aware of this calendar. You can have the cleanest fair value gap present itself, but if it's right before, for example, the big 3 news event, NFP, FOMC, CPI, you have to avoid that. You cannot trade that. That is gambling. The volatility seen on these news events are so huge and unpredictable that if it goes against you, you are more than likely going to get slipped. And all that means is that you're going to get filled at a price that you did not expect to get filled, because price moves so fast on these news events that it basically just teleports from point A to point B, and it does not factor in your stop loss. It will just completely ignore it. So avoid that and don't do that. And the last thing is don't chase. If price whips away from a fair value gap without giving you a clean entry, leave it. Your edge comes from patience and discipline, not from forcing trades and chasing the market. There will always be another setup. And lastly, let me make this very clear. In fact, I'll bring down the mic because that's just how clear I want it to be. Price can retrace into a breakaway gap. Price can retrace into a rejection gap and still move higher off of those. At the same time, price can come into a consolidation gap, that high probability for value gap that we talked about, and still fail that. Be prepared to encounter this because the market is not a perfect place. I want to make you very aware of this now so you don't go into your charts and start tripping out thinking that this whole lesson was a lie because you saw a breakaway gap get filled and you saw a rejection gap work. Of course, you're going to find a bunch of examples of that happening. The market is not perfect. There are no 100% guarantees with anything in trading. So using what we learned today, you can create very accurate expectation and forecast as to what is going to likely happen next in price. Now let's take a look at our first example over here. We're on the NASDAQ, and I first want to show you a beautiful example of a rejection gap. So this right here is your rejection gap. Why? The way the third candle forms tells us everything. So over here, we see a huge bullish rejection, meaning on the lower time frame, this is a lot of bullish intention. We have a lot of bullish order flow, bullish for value gaps now pointing higher likely on the daily and possibly the weekly. We also have closed above that previous candle's low, just forming a textbook rejection candle right there. And again, just to rehash, remember what makes up a fair value gap. The first candle can be whatever, the second candle is always an expansion, and then the third candle tells us a lot. So this right here are your lower probability fair value gaps, where if you actually take a look back at the weekly forecast on my channel, I had a very high conviction that this was going to fail, and I was leaning more towards seeing all-time highs than seeing an IRO to ERO move from that fair value gap to see lower prices. To me, that just made very little sense. So this fair value gap is something to be very suspicious about. Let's see how this played out. And over here, we actually create a breakaway gap. Very textbook example. Remember, the way the third candle forms tells us a lot. The third candle actually expanded above that previous candle's high right here. Remember, a fair value gap, 3 candle pattern, candle 1 can do whatever, candle 2 is always an expansion, and candle 3 tells us everything. Over here, we expanded and closed above that previous candle's high. Breakaway gap, we don't expect this fair value gap over here to get retraced into. So if we already want to move higher, we can look at this candle's range right here on the lower time frames. Is there any fair value gaps already pointing higher that we can retrace into to then push higher? Now over here, we see the price action that actually created that monthly expansion candle, right? So that creates all these lower time frame fair value gaps, all this lower time frame bullish order flow that we can already look to frame IRO to ERO from. We can look to trade higher off of these fair value gaps and not expect price to want to come all the way down here to then move higher. We can already push higher off of those dailies. Now you might be wondering, but this says daily bag. Well, not really. It wouldn't really be a daily bag because we just swept buy side liquidity. This gives us a reason to actually retrace. We are respecting a premium array right here. Notice the respect right here. The bodies tell us everything. This is candlestick logic. I have a video on this. I will also link that in the top right so you can check that out. We respected that. So we have reason now to actually retrace and then potentially move higher off of that. So let's see how that panned out. As you can see, moving higher. Now let's take a look at gold here, and we'll notice that we have a consolidation gap right here. These are your high probability fair value gaps when that third candle consolidates. Now you might be wondering to yourself, why is this not a breakaway gap if we close above the previous candle's high with a candle body? Would that not be a breakaway gap? And no, it's not. It's not that black and white. You can't just look at the candle body closure above the previous candle's high. You have to take into account this actual candle. An important part of it is it an expansion candle? An expansion candle would look more so like this, where we closed above right here and actually had a bigger body, whereas over here, notice how we have a rejection wick right here. Not too bearish, where we're creating an expansion candle lower in a small fair value gap and just creating a whole lot of bearish intention. But it's more so, to me, a consolidation candle where we didn't expand higher and we didn't expand lower. We're kind of just chilling right here. So to me, this is a very high probability for value gap. And also, taking a look over here, just another example of a breakaway gap right here that we don't expect price to retrace all the way back down into, right? This is what I would have wanted to see to consider this a breakaway gap. Notice how big of an expansion candle this is. This is what you want to see for a very clear high probability breakaway gap that we don't expect price to come into. Not this. It's not just candle closure above the previous candle's high. Expansion is an important part of it. So let's see how this played out. And as you can see, we moved beautifully higher, leading us into price action right now, which is in a very textbook example of trapped order flow, which we briefly touched on in the slides. I do have a whole video on this, which I highly recommend you watch. I will link that in the top right. But just to quickly run you through this, why that is trapped. Well, we are stuck in between this bullish weekly fair value gap right here, which is a discount array that can potentially push us higher, and also trapped between this premium array, this daily bearish fair value gap that can push us lower. So price is stuck in a cage, and when price is stuck in a cage, it doesn't have clear direction, doesn't have a clear intention whether it wants to go up or down, so it likely will move sideways. And that's exactly what gold has been doing here for many, many days. And right now, if you're wondering why it's marked out hollowly right here, this is the shield indicator in action. It automatically detects trapped order flow and consolidations for you. And obviously, not the type of price action you want to be trading in. So there's a textbook example over here. What you should do next after watching this video is build a case study in your journal of a bunch of examples of everything we learned today. Build case studies of breakaway gaps, rejection gaps, the consolidation gaps, annotate them, take a bunch of screenshots, go back in price, and just get comfortable with what they look like and how they play out. If you don't do that, and you just watch the video and move along thinking you're going to remember everything in this lesson because you're just sort of genius, that's not going to happen. You're going to forget about it. I highly implore you to journal, take notes, and spend time with everything you learned today. Otherwise, you're just wasting your time here. Now, you most likely noticed that I did use an indicator that automatically marks out all the breakaway gaps for me and all the relevant fair value gaps for me. That is my order flow indicator that we developed as a custom tool to automate all my charting for me. And you can also try it out for literally just $1 for 7 full days. The link will be in the description for that. I highly recommend you try it out. Honestly, like, I can't live without it. It has saved me so much screen time. I implore you to try it out. It's literally $1. See if it's for you, or if it's not, it's all good. No bad feelings. But it streamlined everything for me, so I'm trying to put y'all on. But anyways, if you found this video insightful, I would greatly appreciate if you liked, commented your biggest takeaway down below, as well as any future videos you want to see from me, as well as subscribe. That would be super appreciated. It would really show me that you guys appreciate what I'm doing here, and it would inspire me to be more active on the channel and make more videos for you guys. If you have any further questions on this, as always, I am inside of my free Discord. It is a community of over 26,000 people. If you're not in there yet, you're missing out, because I promise it's better than like those $1,000 mentorships you might be paying for. You can ask me any questions in there, as well as get access to all of my outlooks and daily biases on indices and just things I'm looking at in general for that day, all for free. So the link will also be in the description for that. All that being said, much love, peace out, to the next one.